Good evening. Good evening, accounting students. This is Professor Hassey. Today's date is Thursday, July 21st, and this is our class number 5, week number 7 lecture for our accounting class. This week, we're finishing up merchandise accounting, inventory accounting, cash and internal controls, and I don't think we'll get to plan assets, but we'll see how much time we have. I've made some changes to our schedule for this summer and make it a little bit easier on you all. I have posted all the grades up to this point in time, and so you can see how we stand. And so let me bring up our final schedule for our class. We have 1 week to go. We will have a lecture next week on Thursday, July 28th. Our final examination will be posted this Sunday, July 24th. And it'll be due Sunday, July 31st. But you will have a review lecture next Thursday, the 28th, and I'll record that as well to help you finish out the course. But everybody's doing pretty well in a difficult format with only 3 students for this summer. So let's take a look at where we stand in our class heading into this lecture. Okay, here's our Blackboard account, which you're probably being very familiar with. And if I go to our information about our course, I've adjusted or changed some of our course due dates. Naturally, we did not, our last graded work was a quiz number 2, and those grades have been posted. I've canceled the midterm examination. I've canceled quiz number 3. Our last work in this course will be the final examination, of which which will be posted next week. And it says due July 31st, but you have extensions, and the last possible date for the examination is due August 3rd. So you have about 10 days to do the work. Not too bad. It's going to cover through chapter 18. And it's basically a review of our final weeks in the class. It's going to ask you some questions about merchandise accounting and inventories, which we're covering tonight, questions about bank reconciliations, and questions about plan assets, depreciation, and managerial accounting from Chapter 18. There'll be no work through Quiz 2. In other words, the final examination is going to be the second half of the course, which was basically the midterm and the quiz. So a little bit easier for you to do all the work, complete all the work, and less burden on you with all these other grades going on. So we canceled a few things just to make it a little bit easier for you. And I think it will cover all the things you need to cover, and it should be fine. So we are now in class 5. This is our subject for tonight, and there's our schedule. We're going to cover, we've already finished the accounting cycle. Now we're going to talk about accountability in cash management and collections, which is basically merchandise accounting. And so here are some review points, some PowerPoints, but I'm going to give you some examples tonight in our lecture, which should suffice for the things you need to know about this material. Again, we are now working on our studies for the final examination for next week. We have tonight's session, and then we have a review session or a final class lecture next Thursday, July 28th. Now, here's a couple of spreadsheets, or a spreadsheet that I have posted as one of our class review spreadsheet files. It covers chapters 5 and 6, merchandise accounting and inventory accounting. And these are 2 examples of which can be your study guide for these chapters, problem 5.1a and problem 6.1a from that material. Basically, it's the same transactions. You're just recording for inventory. Remember, retail accounting is the purchase of product that you're going to sell again to another a customer. You're not producing a product, you're just buying a product and then reselling it. When it becomes an expense, that's when you sell the product. So let me give you an example. Here's a transaction on July 1st. The company orders $6,000 of product and they pay for it on credit. So they're purchasing the inventory. It goes into a debit account, merchandise inventory. That is an asset account, inventory. And then they purchase it on credit for $6,000. So accounts payable. We've seen that transaction before. Then The very next day on July 2nd, they take some of that inventory and sell it to their customers. They sell it to them on credit at a retail price of $900. So they give them an invoice, debit accounts receivable. They owe the money to us, and it's a credit to sales. We've sold $900 at retail of that merchandise. But if you notice, right underneath that transaction is a transaction debiting cost of goods sold and inventory $500. What this is this is the cost of that inventory that you sold for $900. In other words, we bought $6,000, but now we're selling off $500 of that inventory. What's our inventory balance now? $5,500, but we're selling it for a retail price of $900. So in other words, that's the markup. It cost us $500. We're selling it to our customers for $900, a markup or a gross profit of $400. Pretty simple. The key thing, this is the difference between the accounting that we did for a service agency or a service company earlier in our course, is that you have to record the retail price of the product as sales, and then the cost of the product to you as now becomes an expense, the $500. That's the only major difference between this accounting and the accounting of the prior work in our class. You have to record the retail price and the cost of the merchandise as an expense. It's an inventory, it's an asset. Then when you sell it, it goes from being an asset to an expense. And the cost of goods sold is an expense account. And you lower your inventory balance because you sold that product. What did you sell it for? $900. And in this case, you billed your customer receivable, but you still record the revenue as sales. Well, let's look at a couple more examples of this type of retail inventory. Many times you purchase inventory and you have to pay the freight. When they deliver it to your store or deliver it to your business, there's also a freight charge of bringing that inventory to your store. You have to pay the trucking company that delivers the merchandise. And in this case, the freight charge was $125, of which we paid in cash. And then the debit goes into inventory to add to the cost of the product that you're selling, the freight cost of delivering the product to you. So you debit inventory $125. That's the freight charge. The next transaction, now we sell more product. And this time, instead of billing, we get cash. We sell $1,700 of retail product at debit cash and credit sales. Now, in the problem, they tell us that this retail price of $1,700 cost us $1,300 to purchase from that vendor back here of $6,000. So notice, just like we did up here, we have to record the cost of goods sold or the expense or the cost of that merchandise as a debit for $1,300, and we credit inventory $1,300. So now our inventory balance is $6,000 less the $5,000 here, which is $5,500. We added in another inventory amount as freight, so that's $5,625 balance. And now we reduce that by another $1,300 because we're selling more product. So that brings us down to about $4,300. Again, retail price books into sales. The cost books as an expense and reduce the inventory balance by a credit. Then on July 9th, looks like we purchased some more inventory, $2,200, and we buy it on credit, accounts payable. More inventory now comes in ready to sell. But this example has a little bit of a problem. When we purchased the $2,200 of inventory and they delivered it to us on July 11th, we found that $200 of that inventory we didn't like. Either it was damaged or it wasn't the product that we ordered from the vendor. So we make what is called a purchase return entry, where we lower accounts payable by the returned merchandise, $200 debit, and we lower or credit inventory because we're returning part of that $2,200 as returning it back to the vendor because we didn't like it. We're returning it. $200 credit to inventory. Okay? So we're returning merchandise. And I'm sure some of you have done that in your own everyday lives. When you return merchandise, and either you get a credit back on your credit card or you get your money back. The next transaction is an interesting transaction because in this transaction, it says that we're selling our product. We're collecting. Remember up here, we had this accounts receivable for $900. Well, part of the sale was you can get a discount of 2% if you pay within 10 days of the invoice. In other words, when I sold this $900 to this customer, I told the customer to encourage them to pay me on time. I will give you a 2% discount on your receivable balance if you pay within 10 days of the purchase or the invoice. Well, lo and behold, 10 days later on July 12th, they pay me the $900, but I give them a 2% discount. 2% of 900 is 18 bucks. So I wipe out the receivable, but I only collect cash, the $900 less the discount. So they're only going to give me cash of $882. The remaining $18 goes into a debit account on sales discounts, which reduces the sale of that by $18. In other words, I'm willing to give them a discount so I get the money quicker. So I sold it to them for 900, but now there's going to be a debit in the revenue account sales discount, lowering how much I sold them by 18 bucks because I gave them a 2% discount. And as a lot of you know, in retail, many companies give their customers discounts, encouraging them either to buy the product or encouraging them to pay quicker. And that's what's going on here. The next transaction is, remember when we purchased the inventory up here for $6,000, that vendor also gave us a discount. When we purchased it from the vendor said, if you pay this invoice or this bill within 15 days, we will give you a 10% discount, or excuse me, a 1% discount. All right, cool. So I owe $6,000. I'm paying within 15 days, so I get a 1% discount of $6,000. I get a discount of 60 bucks. So I now credit cash. So now I write them a check for the $60 minus how much I owe them, $5,940. And the discount on the purchase goes as a credit to inventory. What I'm doing is I'm lowering my inventory balance because I'm only really purchasing $5,940 of inventory because I'm getting a discount when I pay the bill. Debit payable, wiping out the payable, credit the discount, 1%, and writing a check to that vendor for the difference, $5,940. All typical examples of the retail business. Then the next one is we sell more product for $1,200, and this is billed sales receivable, of which that $1,200 was the retail price. Remember, every sale, 2 entries, one for the revenue and one for the expense. It cost us $800 to purchase the product that we sold for $1,200. Debit cost of goods sold, credit inventory. Now, at the same time, some customers who bought some goods from us returned the merchandise to us. In other words, we sold some product and they didn't like the product, and they're returning that product to us. It cost $100. So we're going to lower their amount that they owe us, credit receivable, by the amount of product that they returned to us, $80. And at the same time, we return that as a debit to sales returns. In other words, another debit balance revenue account that shows our sales are going to be reduced because some of the product was returned to us. All right. Sales returns, sales discounts, purchase returns, purchase discounts, all examples of the process of retail accounting. On this purchase of, remember we bought $2,200 of inventory here, and then we returned $200. So we had a balance of $2,000. Well, part of that deal was if you pay us within 15 days, we'll give you a 2% discount. Well, we have a balance of $2,000, so we're going to take a 2% discount. 2% of 2,000 is $40. Thus, we only have to pay the vendor $1,960 because we're paying within the discount period. Because this is a purchase, we lower our inventory balance by that discount, and we wipe out the payable up here. Now we have another example. Remember, we had that sale of accounts receivable here of $1,200, of which we gave $100 credit on because they returned some of that merchandise, so they owe us $1,100. Now they're paying us back within the discount period, so they're getting a 2% discount on $1,100. So they're wiping out the receivable. 2% of $1,100 is $22. That's a sales discount, and the difference is how much cash we receive from the customer for paying their bill within the discount period. And finally, one last entry for sales, billed sales of $7,000. And those sales are now recorded just like this. And what is the cost of those sales? $4,800, debit the expense, and credit inventory. Wiping out the inventory because we've now sold it for a retail price of $7,000 and a sales and a cost of $4,800. This problem is a perfect example of retail accounting and the various tractions: the purchase of the product for inventory, the sale of the product for inventory, freight charges, the returning of merchandise for credit, sales discounts, purchase discounts, all types of entries, all the entries you need to know for retail accounting. And there they are right there. At the same time, in regards to retail accounting, there's also inventory accounting. Many times companies keep track of inventory like this. They purchase it, they sell it, they keep a ledger of all the changes in the inventory account. Other companies, though, like to take a certain value of the inventory at a particular time, and they use inventory valuation methods to determine that. For example, this is problem 618. Here's a company with a inventory balance of product ready to be sold that costs them $50. They have 100 units, so that's $5,000. Then on March 5th, they purchase an additional 400 units of that product for inventory, but the price went up to $55. So that's $22,000 of merchandise they're producing. Then on March 18th, they buy more inventory, but the inventory now value changes to $60. It's the same product, but it goes up in price. Woo, find a new vendor. $7,200. And then finally, again, they buy 200 more units of the inventory at $62, $12,004. So during the course of this month or accounting cycle, they have 820 units available for sale, beginning and additional purchases, and the total cost of all that inventory is $46,600. All right. Well, let's say they sold 580 units of that 820 units during the month of March. So that means they had 820 units available in their inventory. They sold 580. That means they sold or have remaining 240 units of inventory. Now, because these inventory items are all the same, but they came in at different dates and different prices, how do I place a value on that 240 units? Well, we can use a series of steps called Lifo and FIFO of a way of determining the inventory values of this 240 units. What do I mean by that? Goods purchased first are the first ones sold. So your inventory is made up of the most recent purchases. LIFO, goods purchased last are the first ones out or sold. That means your inventory is made up of the early inventory items. Seems kind of weird, huh? But if you can see, a business has the options of choosing different ways of valuing their inventory. Let me show you the example. Under LIFO or FIFO, goods purchased first are the first ones sold. So remember, we had 240 units left in inventory. So this 240 units must be made up of 200 units at $62 and 40 units at $60. 40 units at $60. In other words, based on first in, first out, we assume these are the first ones sold. And what makes up the $240 ending units is 200 at 62 and 40 at 60. All the rest of those units have been sold. So if I do that, that's what? $14,800. That's my inventory valuation using the FIFO system. What that means is if my inventory was $14,800 and I have $46,600 of available inventory, the difference between $14,800 and $46,600 must be my expense, the cost of goods sold. So their expense is $31,800. The balance on their balance sheet and inventory is $14,800. Now you might be saying, Mr. Hasse, why are you doing this? Because earlier in our Chapter 5 transaction, you recorded the inventory as we went along. Okay, there's nothing wrong with that. That's called just in time or point of sale inventory. Nothing wrong with that. But a company has the option to do that or do the accounting this way after the end of the period and calculate the inventory values using these methods. The IRS lets them do it that way. Under LIFO, last in, first out, it means all these units are being sold. And what makes up the LIFO inventory is 240 units, 100 units at $50, and 240 units at $55. So our ending, oops, what did I do wrong here? Let me double check this, check my arithmetic. Okay, I fixed my arithmetic. So in last in, first out, the goods purchased last are the first ones sold. So your inventory is made up of your earliest purchases, 100 units at $50, and then 140 units at $55. 100 and 140 equals your ending inventory. So if I do that, that means our LIFO was $12,700, meaning our expense was was making sure this has to equal 46,600. So let's do that here. I still didn't fix my arithmetic, Mr. Hasse. Meaning our cost of goods sold are $33,900. They have to total the amount available for sale, the total of all the inventory. Part of this is an asset, part of this is an expense. But notice, two different methods. We're making more money here because our cost of goods sold is cheaper. We're making less money here because our cost of goods sold is more expensive. Two different methods to compute inventory. FIFO, first in, first out, LIFO, last in, first out. This is what Chapter 6 is about, is a different way of accounting for inventory. Now, the last item for this week's lecture is Chapter 8, and it's called Accounting Controls. Understanding how to balance your checkbook. I'm sure a lot of you, as good personal financial managers, you balance your checking account every month, making sure what the bank says you have equals what your cash or checking account balance has in your checkbook. It's called balancing the accounting, balancing the checkbook. Well, businesses, this is very important because it shows the market, it shows bankers, it shows people that you are efficient. You can control your information and balance it. A lot of banks will not lend you money if you don't have good accounting controls. Accounting controls is like reconciling your bank account, making sure you keep all the receipts and all the transaction records. If you don't do that, you're sloppy, and a lot of people aren't going to do business with you. So in Chapter 8, they're talking about an example of a bank reconciliation. So here's a company's bank account and their cash ledger balance on July 31st. They have $27,233 in the bank. They have $27,497 in their cash account ledger balance. So what you do now is you reconcile. If something appears on the bank statement balance or bank statement that is yet to appear in your cash account, you have to reconcile it. If something appears in your cash account but has yet to be involved in your bank statement, you report it over here. Example, in my $27,497 cash balance are 3 checks that I have written that have yet to clear the bank. They haven't cleared the bank yet. Check 3031, 3065, and 3069. So these checks have been deducted or credited to my cash account, but the bank has yet to see them. It's not in that balance. So I have to deduct them from the bank balance to show that eventually they're going to clear the bank. It's called outstanding checks. So the total of these $4,145 is the reconciliation balance, taking them out of the bank account to match the cash account. At the same time, at the end of July, this company deposited $11,514 in this balance. But on the bank statement of July 31st, that deposit had yet to show up on the bank. Did you ever take a deposit to your ATM machine or to a bank and you deposit it and it says those funds are not going to be available for 24 hours? That's exactly what that is. It's called a deposit in transit. So since this $11,514 was included in this balance, I have to add it back in as a reconciliation item to my bank balance. I subtract out outstanding checks. I add in an outstanding deposit. There's my reconciliation balance of $34,602. Now, what information appeared on the bank statement that has yet to appear on my cash account? I wrote a check number 3056, and I made an error. I said when it cleared the bank, I made an error of $20 on that. I made an error. I goofed. I wrote it in the bank balance, in the cash account balance, $20 less than what it actually was. So I have to subtract $20 from my cash balance for that error. At the same time, in the deposit made to the bank statement, $805 was a bad check, an NSF check, non-sufficient funds. So in other words, we deposited money into our cash account, and then when we got the bank statement included in this, they deducted it from our balance because it was a bad check. So I have to deduct this balance from my cash account for being a NSF, a bad check. At the same time, on the bank statement, they told us that we had a $25 bank fee during the month of July. I did not know that until I saw the bank statement, so we deduct $25 from that. Also, we saw in the bank statement that the bank collected a note for us for $7,955. We didn't know about that until we saw it on the bank statement, so we have to add $7,955 to our balance. And look what happens. We subtract the error of the check, we subtract the bad check, we subtract the bank service charge, we add back in the note, and look what happens. We now are balanced. This is now called a reconciled account. The cash balance reconciles to the bank balance. All these transactions will clear the bank eventually, and I'm going to have to do a adjusting journal entry here to get these changes in my cash account balance because of this reconciliation. You don't have to do a journal entries here because these will clear through the bank. They're already included in this number. But I have to make adjusting entries to record the note collection, debit cash, credit receivable, the $805 bad check, putting it back on receivables and reducing cash, the error on the check, which was for rent, debiting rent expense and crediting cash, and the miscellaneous or bank service charge, $25, and credit cash. Notice for deductions here, I'm crediting cash, and for additions, I'm debiting cash. I post these adjusting entries, and they now make this balance match the bank adjusted reconciled balance. You have to do this every month because when you're audited by your public accountants, when potential investors want to see your accounting controls and they say, all right, show us your latest bank reconciliation. Huh? We didn't do it. Well, that's not going to make your efficiency and your company look very good. Thus, you reconcile it. Okay, we've looked at retail accounting, we've looked at inventory accounting, inventory valuation, and now we've looked at reconciling cash by doing a bank reconciliation. So for next week, July 28th, we're going to talk about Chapter 10, depreciation, plan assets, and we're going to talk about Chapter 18, the definition of managerial accounting. And that will conclude our course. So our final examination will be made up of chapters 5, 6, 8, 10, and 18 of what we studied this week. And I will post this examination for you on July 24th, this Sunday. And you'll have more than, you can post it on the 31st, but you have until August 3rd, technically, with extensions, to turn it in. But I also will give a lecture next Thursday night to talk about Chapter 10 and 18 to help you with those questions on the final. Once we do that, we're all done with our course, and you've done a good job. So if you have any questions about this schedule or any concerns, please let me know. I'm around now. I'm back from my travels back to Michigan and taking care of sick parents. I'm back here in Claremont. I'm available for any questions, but you have our schedule. One more grade to do. No grades this week. Your grades due next week with the final examinations, chapters 5, 6, 8, 10, and 18. Thanks, everybody. I appreciate your patience. I'm posting this video this evening, Thursday, July 21st, and I'll talk to you next week. Take care.